The global economic collapse has already begun, and it is destined to become the most devastating financial meltdown ever. Sadly, few realize it and are completely unprepared for what lies ahead. In fact, what many fail to understand is that this looming crisis is nothing less than a global financial reset meant to transition the world into a fully cashless society, just as prophesied in Revelation 13. The Bible has long foretold the coming of a global financial system that would be linked directly to the mark of the beast. So how could we prepare for it, and what should we expect in the coming months? This question is extremely important, and that's why I intend to fully cover both the spiritual and physical ways in which the church could prepare for the future. But first, let's take a look at the many factors that are now converging to create the perfect economic storm, and why such a crisis is being used to deliberately sabotage the global economy. So here's what you should know. In economic terms, a contagion is any factor that contributes to the demise of the financial markets and ultimately the entire global economy. Currently, there are 7 such acting factors, some of which are extremely detrimental. In the following list, we will identify both the systemic threat to the global economy as well as the other conditions that are presently eroding the world's financial markets. How serious is the situation? Well, I'll leave you to decide that for yourself after you examine the following points. Point number 1. Rising U.S. interest rates. Undoubtedly, the global financial system is both controlled and maintained by the U.S. Central Bank, better known as the Federal Reserve. Following the global economic crisis of 2008, both the Federal Reserve and the central banks of other countries agreed to implement quantitative easing in order to rescue their respective markets from total failure. Quantitative easing, or QE, is the buying or selling of short-term government bonds to keep interbank interest rates at a specified target value. This typically involves the central bank buying government bonds to lower short-term market interest rates. After 2008's economic failure, U.S. interest rates dropped to near zero, or 0.25% for the first time in history. Of course, the U.S. led the way in QE by implementing zero or near zero interest rates for nearly a decade. Needless to say, this only created runaway inflation and increased our national debt to unsustainable levels as the government kept printing massive loads of fiat currency. At the same time, the world's emerging markets were encouraged to buy up treasury bonds in order to prop up the American economy and thereby bolster their own economies also. Among these were China and Russia, who proceeded to gobble up U.S. bonds and treasury notes almost immediately. But China exceeded the other emerging markets and quickly acquired the largest amount of U.S. debt. As a result, China now owns roughly 19% of the $6.3 trillion in U.S. treasury bonds held by foreign countries. Now, following the crisis of 2008, U.S. interest rates continued to hover near zero to artificially stimulate global economic growth. But in 2015, all of that changed when the Federal Reserve started raising interest rates once again, and they plan to continue to do so well into 2019. This reversal of policy is known as quantitative tightening, or QT, which is the opposite of QE and corresponds to rising interest rates. Currently, we are in a new cycle of quantitative tightening. But you see, nearly every time the Federal Reserve increases interest rates, it almost immediately triggers an economic recession or a market crash. In fact, you could find this very predictable pattern by looking at our stock markets since the founding of the Federal Reserve in 1913. Now, what's important to realize is that with each new cycle of quantitative easing, followed by quantitative tightening, the global economy is exposed to a more severe economic failure. Because of this, we should be on high alert now that we've entered into a new cycle of rising interest rates. So who exactly stands to benefit from all of this, and why doesn't the U.S. Federal Reserve implement more stable market controls instead? The answer is simple. Only the government benefits from this ongoing cycle of expansion and contraction. Because what you need to understand is that during these market crashes, the powers of the government continue to expand, while the general public drops deeper into poverty and becomes more and more reliant upon the government for its basic survival. But make no mistake, this is no coincidence, and neither is the fact that the United States is the victim of out-of-control inflation and inconceivable debt. So what do you think happens when interest rates go up? Let me break down the answer for you into the following 2 categories. Category 1 is the domestic population of the United States, while Category 2 is the global population in foreign countries. In Category 1, higher interest rates correspond to market deflation, which then results in a dwindling money supply, lower demand, falling profits, lower wages, lower income, more layoffs, higher unemployment, and bankrupt businesses. At the micro level, middle-class Americans are most affected since they currently own more debt than any other population in the world. And since their monthly mortgages suddenly increase along with their car payments, student loans, and credit card interest, it quickly results in a staggering default epidemic. Okay, but what about Category 2? How is the global population affected by rising U.S. interest rates? You see, following 2008's global economic crisis, markets around the world merged together to become one big synergistic network. However, the biggest benefactors of this new financial environment were disadvantaged or developing countries, also known as emerging markets. And since that time, emerging markets have received roughly $4.5 trillion of gross capital inflows, representing about half of global capital flows. This was primarily due to the super low interest rate environment across developed countries such as the US. But now, as US interest rates begin to rise, it causes the US dollar to automatically strengthen against other currencies, which causes foreign currencies to suffer mass depreciation, especially those within emerging markets. This is partly due to the fact that global investors are lured back to the US, where they can now earn higher interest yields on traditionally safer securities rather than the riskier investments offered by emerging markets. The second reason why emerging markets suffer is because all of their US Treasury securities are suddenly devalued, which is why they're dumping their US debt holdings at record levels. And this in turn floods the US bond market, which then causes the US dollar to plummet in value or depreciate, spiking the cost of imported goods to record highs. Therefore, it is certain that as rising interest rates take their toll, the full effects of this scenario will play out with much greater intensity. So I hope we could better appreciate the detrimental result of rising US interest rates on both the domestic and global economy. But some of you might be thinking, well, hasn't the US maintained much higher interest rates in the past compared to where they stand today? After all, US interest rates were as high as 20% back in 1980, so what's the big deal with raising US interest rates by only 2.5% or even 5%? Normally, rising interest rates signal a healthy economy, tame rapid inflation, and translate into higher returns for savers. But here's the difference between our economy in 1980 and what it is today. In 1980, the US debt stood at $908 billion, whereas today it stands at nearly $22 trillion. That's a really big difference. Secondly, countries like China and other emerging markets were fundamentally decoupled from the US economy and had no significant bearing on our markets. Yet now that is no longer true. Foreign countries like China own a great deal of our debt and could at any time demand to redeem it for gold. And so the stakes are much higher if we should default on the debt we currently owe. Thirdly, with US interest rates already set to extremely low levels, there is really no room to lower them any further to stimulate the economy when the next recession strikes. And fourthly, Rule 10b-18, which was passed by the SEC or the SEC in 1982, is literally a ticking time bomb waiting to happen, and the current market conditions are ripe for this disaster to strike. But we will examine this bill in greater detail a little later. For now, though, it is important to realize that raising U.S. interest rates within the current financial climate is nothing short of economic suicide, and you can be sure that the powers that be are fully aware of it. In fact, just recently, President Trump has voiced his strong disapproval of the Federal Reserve's decision to raise interest rates. Just take a look at the following news clip.
And President Trump taking notice of the market volatility and stepping up his attacks on the Fed, and Fed Chair Jay Powell in particular. In an interview this time with the Wall Street Journal, the president said he thinks the Fed is the biggest risk to the economy because it's hiking rates too quickly. And this isn't the first time he said this. This is echoing his comments from recent comments. He said he's unhappy with the Fed because Obama had zero interest rates. President Trump also took aim at Fed Chair Jay Powell. He said he thought that Powell was a low interest rate guy. The president said every time we do something great, he raises interest rates. And in his words, it almost looks like he's happy doing it. When asked under what circumstances he'd remove Jay Powell as Fed chair, the president said he didn't know. The Fed has raised rates 6 times since the president took office, so will likely hike rates again in December.
Yes,
and every president likes lower rates. Every
president likes lower rates. Nobody likes to have to fight higher rates and what that does to the economy.
If you read the story, too, though, it wasn't as if the reporter said, so what do you think of Jay Powell?
Right.
He said, what's the largest risk to the economy?
Right. And it's
which you knew was going to be this answer, probably.
The president making those remarks in the Hamptons, according to Bloomberg, saying that he had some suspicions that Jay Powell wasn't necessarily doing the right thing in terms of interest rate hikes going forward. This is a criticism that the president has made before, including to Joe Kernan in an on-camera interview earlier this year. Here's what the president said back then.
I put a very good man in the Fed. I don't necessarily agree with it because he's raising interest rates. I'm not saying that I agree with it, and I don't necessarily agree with it. I must tell you, I don't. Yeah. I'm not thrilled because, you know, we go up, and every time you go up, they want to raise rates again. And I don't really, I am not happy about it. But at the same time, I'm letting them do what they feel is best.
You know, Michelle, my sense here is that the president really wants the Fed to hold off on those interest rate increases, worrying that it could harm the recovery overall. And one of the things that you look at in the history of presidents dealing with the Fed is you've seen presidents who've been frustrated with their Fed chiefs in the past over exactly this issue, raising interest rates, and whether or not that will harm the recovery or the economy at the time.
But here's what's interesting. While Trump appears to be upset with the Fed, he was the one who, after all, nominated Jerome Powell to his current post as Fed chairman, and also, as president, Trump reserves the right to overrule the actions and policies of the Federal Reserve. So isn't it a little strange that Trump appears to be against the Fed's quantitative tightening measures and yet does nothing to stop it? Point number 2, dollar gives up status as world's reserve currency. Since the 1944 Bretton Woods Agreement, the US dollar has risen to the coveted status of world reserve currency. This means that every country wishing to buy goods from another country must do so in US-denominated money only. Essentially, foreign countries are forced to maintain a large stash or reserve of US dollars in order to broker trades with each other. Now, sometimes these countries convert their store of US dollars into US treasuries in the form of notes, bills, and bonds in order to earn interest over a period of time. So you see, this alone has kept the US dollar from collapsing under the weight of its own debt. As long as foreign countries are forced to transact in US dollars, the US government is free to print up as much money as needed to service its own debt without having to immediately balance its books. But how does the US maintain such a hegemony on the world economy? And what happens to foreign nations who decide to transact with each other in their own currencies? Many students of history are convinced that every foreign conflict since the 1940s involving the US has been the result of economic protectionism. But now the rules are changing, and presently there is a very real threat to the dollar's imperial status. So what would cause the US dollar to completely lose its value? The following are 3 distinct threats that would preclude a total dollar collapse. Number 1, an underlying weakness in the dollar. Number 2, China and Japan dump their dollars since they currently possess more US debt than the rest of the world. And number 3, a viable currency alternative for everyone to buy. Okay, so let's examine where we stand in relation to all 3 of these. Does the dollar possess an underlying weakness? Yes, indeed it does. Just consider the mounting levels of unsustainable debt which now represent it. We have an extremely fragile dollar that's currently tipping into hyperinflation. But what about China and Japan dumping their stash of dollars? Could this really happen? As a matter of fact, China and Japan are right now on their 5th-month streak of dumping US Treasury bonds. Just take a look at this headline. China and Japan lead global dumping of US sovereign debt. And as you can see, this article tells us that China is now on its 5th consecutive month of dumping US securities, and Japan is following suit after both countries signed a trade agreement which bypasses the dollar's reserve powers. Yet it's the 3rd and final threat against the dollar that's perhaps the most significant. Because you see, most recently, the United States has willingly surrendered almost all of its national sovereignty by choosing to submit itself to the IMF and its monetary policy. Now, who's the IMF? The IMF, or the International Monetary Fund, is headquartered in Washington, D.C. and poses itself as an international organization working to foster global economic stability. But of course, its purpose is much more sinister. What most people don't realize is that this organization is actively working to create a global financial system in which all sovereign currencies are eliminated and replaced by a single currency. In fact, the IMF had already built the framework for their global currency as far back as 1969. And since 2009, they have begun issuing bigger allotments of their own world reserve money to developing countries hurt by the 2008 financial crisis. So what exactly is their new currency called? The IMF's world reserve currency is known as the SDR and is abbreviated as XDR on the global foreign exchange. Now, what's really important about this global currency is that it gains prominence every time the US dollar weakens or is otherwise unsuitable to be a foreign reserve asset. That's why since October of 2018, on account of the recent turbulence in the US stock market, the SDR has appreciated significantly against the dollar, surpassing it in value. Just look at this graph to see this for yourself. So as you can see, just in December alone, the SDR has risen significantly against the dollar. In fact, it has also surpassed both the euro and British pound in value. But here's the really important question. How far along are we to fully implementing the SDR as the world's reserve currency, and when will it replace the dollar? Actually, we're only a financial crisis away from seeing that happen. And that financial crisis has already begun, as we will soon discover. But before I get too far ahead of myself, let me give you some background to why the SDR is set to replace the US dollar very soon. You see, back in December of 2015, China opened up the first interbank market known as the AIIB, which now offers products priced in the SDR. Yet more importantly, they have the full backing of the World Bank and are now joined by Western members such as Israel and Australia. Yet the fact that this market quickly became the 2nd largest interbank market in the world is truly astonishing, Now, as of October 1st, 2016, the Chinese yuan was officially added to the IMF's SDR basket of currencies in the third most important spot, which caused the SDR to be revalued. But even as far back as 2009, China has been very vocal about its displeasure at the current international monetary system and has promoted measures that would allow the SDR to fully satisfy the member countries' demand for a reserve currency. Notice, China suggests an end to the dollar era. The governor of the People's Bank of China, Mr. Zhu, calls for a radical reform of the international monetary system in which the dollar would be replaced as the main reserve currency by a global currency. And here's another headline from back in 2009. Can IMF currency replace the dollar? World leaders at the G20 meeting agreed to create new international money worth $250 billion. The IMF will oversee the new money called SDRs, or special drawing rights. Some people believe, and China fervently hopes, that SDRs will in due course replace the dollar as the main world reserve currency. Meanwhile, the IMF has shown incredible support for China's stance and produced a paper exploring ways the substance and function of the SDR could be increased through China's cooperation. Now, it should be noted that the IMF has deliberately chosen China to carry out this important assignment, particularly because it is a socialist regime capable of forcefully imposing the SDR on all of its banks and people. And as the world's second largest economy, this would then force the entire globe to shift over to the SDR currency. So could this be why China and Japan are currently signing trade agreements with each other that completely bypass the role of the dollar? It should be carefully noted that Jim Rickards, a well-known economist, has called the SDR a cruise missile aimed at the US dollar. But let us not forget that just recently it was reported by the Business Insider that the IMF was standing by for the next financial crisis so that they could bail out global economies with the SDR. Notice this article for yourself. Who has a clean balance sheet? Who could bail out the system? There's only one organization left. It's the International Monetary Fund, or the IMF. They could print money called special drawing rights or world money. Here's the difference. The next time there's a financial crisis, they'll try to use SDRs. What's going to come is a crisis, and it's going to come very quickly. Point number 3, the US-China trade war. It is my firm conviction that the US-China trade war is part of the IMF scheme to trigger the global financial collapse now underway. Why is that? The answer is simple. Because it gives the Chinese government reasonable cause for dumping the dollar, and more importantly, it permits the US to feign surprise at the inevitable destruction of its own financial system. Of course, when this happens, the IMF will immediately step in to rescue the world economy from complete disaster. But few realize just how serious this trade war really is. Not only is it devastating the global financial markets by depressing investor sentiment, but it is also spiking up the prices of all imported goods into the US. Now, the fact that Chinese products comprise the vast bulk of American retail items is no secret, and therefore President Trump's tariff reprisals on nearly all Chinese exports will undoubtedly create a crisis for average Americans who can no longer afford to purchase these items. Just consider the recent statements published by GM. Increased import tariffs could lead to a smaller GM, a reduced presence at home and abroad for this iconic American company, and risk less, not more US jobs. Auto tariffs would probably raise the cost of making some cars by thousands of dollars, and it warned that the cars that would be hit hardest by tariff-driven price increases are often bought by people who can least afford to pay more. At some point, this tariff impact will be felt by customers, the company said. But then on December 3rd, following the G20 summit, we were told that China and the US had reached a ceasefire, which later proved to be unconfirmed by the Chinese press. Then only a few days later on December 6th, the US had Canada arrest one of the most important CEOs in China, Meng Wanzhou, on charges of violating Iran sanctions, and she now awaits extradition to the US. But who exactly is this Chinese company executive? According to the New York Post, it turns out that Princess Meng, as she is called, is communist royalty. Her grandfather was a close comrade of Chairman Mao during the Chinese Civil War, who went on to become vice governor of China's largest province. She is also the daughter of Huawei's founder and chairman, Ren Zhengfei. So how did China respond after Meng Wanzhou's arrest in Vancouver? According to the news, furious Chinese communists have begun arresting innocent Canadians in retaliation. So far, 13 of these revenge hostages have been taken and are being held in secret jails on vague charges. Beijing hints that the hostage count may grow if Meng is not freed and fast. Even for a thuggish regime like China, this kind of action is almost unprecedented. So obviously the level of tension between the US and China due to this trade conflict only appears to be escalating and does not appear to be getting any better. Point number 4, Germany's Deutsche Bank on the verge of bankruptcy. According to a recent report published by the IMF, German-based Deutsche Bank has become the most systemically important bank in the global financial system. The GSIB, or globally systemically important banks, are linked together with global markets and other firms in such a way that their failure could trigger a widespread financial crisis. We call these banks too big to fail because they are literally too important to the world's economy to risk going under. However, these too big to fail institutions are also too big to bail out. Here's why. The derivative exposure of Deutsche Bank alone is nearly $55 trillion. That's more than the gross world product, or GWP, of all of Europe and the United States combined. But here's the problem. As of the last few years, and especially in 2018, Deutsche Bank's share value has been plummeting dramatically. Consider the fact that a single share was worth nearly $20 back in January of 2018, compared to December of the same year when it fell to just below $8. But what's really concerning is that if Deutsche Bank shares fall to the $5 mark, this mega bank will be forced to declare bankruptcy, leaving the world's economy in grave peril. Could this happen? Consider the fact that back in November, the bank sustained a massive bank raid on its main headquarters due to money laundering suspicions, and this raid is expected to cause the bank's shares to drop even further. Here's a brief news clip covering the event.
Brian, tell us more then about this raid carried out today.
Well, first of all, Claire, no small operation here. 6 offices raided around the Frankfurt area, 170 officers, not just the police, prosecutors, tax inspectors as well, for money laundering purposes is what the authorities are accusing them. Now, the investigation stems from this massive 2016 whistleblower leak known as the Panama Papers. That, of course, was this huge trove of documents leaked from the Panama-based law firm.
Now, this investigation is particularly bad timing for Deutsche Bank, isn't it?
It is. It's unfortunately nothing new for the bank. It's the second ongoing investigation involving Deutsche Bank in Europe. Authorities in Denmark are investigating Danish lender Danske Bank there for another money laundering scandal, separate, but that's one where Deutsche helped to process the payment, so they're implicated there too. Now, Deutsche is also, apart from these legal troubles, in the midst of a restructuring plan that includes thousands of job cuts. They've been losing money for years, like really bleeding a lot of money, and the bank has paid out over $18 billion in fines and legal settlements. That's since 2008. So misconduct claims make up a significant part of that money losing there. Now, shares today were down 3.5% already. And in fact, Deutsche shares, as we see here, have lost just around half of their value since the start of the year alone. So it's troubled times there for the bank.
Point number 5, new, looser requirements for big American banks. October 2018 turned out to be the most volatile month in the U.S. stock market since 2008. At the end of this very volatile month, in which big banks lost significant share value, the Federal Reserve announced a very significant rollback to banking regulations. This recent change allows big banks to once again play fast and loose with the public's money with little to no oversight by governing agencies. Notice this excerpt from the Wall Street Journal. Fed proposes looser rules for large U.S. banks. The Federal Reserve announced one of the most significant rollbacks of bank rules since President Trump took office, with a proposal for looser capital and liquidity requirements for large U.S. lenders. So why would the Federal Reserve loosen banking requirements when those requirements were put into place after the 2008 financial collapse to prevent the big banks from engaging in risky behavior? Why would they roll back safety measures that were erected specifically to ensure banks maintained enough liquidity and capital so that their members' savings accounts were kept safe? Could it be that the Federal Reserve is deliberately enticing big banking corporations to engage in reckless behavior without the rule of law to deter them? Is this how the IMF, with the help of the Federal Reserve, aim to jeopardize the present economy and run it off the cliff so that their new cashless system can replace it? If you ask me, that's exactly what we are witnessing. Point number 6, record-level stock buybacks. When the Trump administration passed the Tax Cuts and Jobs Act of 2017, job growth was the word on every Republican politician's lips. Mike Pence, Stephen Mnuchin, and Donald Trump himself spoke of the new bill as an economic miracle pill for the middle class and the economy, which perhaps it could have been if the first priority of corporations was to increase worker salaries. But new studies reveal that the extra profits reaped by corporations from the tax cuts are going in a different direction. Instead of money being spent on workers and job creation, corporations have amped up their buybacks, investing in their own stock. Now, ever since the new tax law was signed on December 22nd of last year, announcements of plans to buy back stocks have poured out of Wall Street. A newly released report from Politico shows that CEOs have overwhelmingly used the extra capital generated from Trump's reduction of the corporate tax rate for insider sales. According to Politico, some of the biggest winners from President Donald Trump's new tax law are corporate executives who have reaped gains as their companies buy back a record amount of stock, which then rewards shareholders by boosting the value of existing shares. But here's what's important to realize. Company buybacks stimulated by these new tax cuts have driven the stock market to record highs never before seen. Consider the fact that the Dow Jones topped a record-breaking 26,828 on October 3rd of 2018, just before dropping into a free fall over the following weeks. Consider also that before 2017, stock markets averaged highs of between 15,000 and 18,000 basis points before gradually descending to normal fluctuating levels. But then after December of 2017, something strange happened. The stock market kept climbing higher and higher as Wall Street celebrated exuberantly. Meanwhile, few realized that the coming plunge is both inevitable and unstoppable. Having been driven so extremely high, the market is poised to crash by a devastating 70% or greater in what will become the worst financial meltdown in history. Point number 7. Record-level retail defaults. Giant retailers across America are filing for bankruptcy at record levels, and many are comparing the woes facing retail in 2018 and 2019 to the housing market of 08 and 09. In fact, the situation has become so critical that it is now being called the retail apocalypse. Iconic names such as Sears, Kmart, the Bon-Ton, GNC, J.Crew, and many others are simply dropping out of existence. And one recent casualty, Toys R Us, is the third largest retail bankruptcy in U.S. history. According to the latest data, over 50 major chains went bankrupt in 2017 alone. That's up from 47 filings in 2016 and 30 in 2014. So when compared to the recession years following the last financial crisis, these figures are absolutely staggering because only 12 major retailers filed for bankruptcy between 2008 and 2010. So what's in store for the future? Just as many or more retail bankruptcies are expected in 2018 and 2019. But why should you care about these mega retailers going bust? Perhaps because retail represents the single most vital sector in microeconomics. Just consider the fact that the number 1 and number 2 job slots in the U.S. economy are comprised of salespeople and cashiers, which total nearly 10 million working Americans. Yet presently, these jobs are being lost at record pace as more and more retailers close thousands of stores across America. According to most reports, over 10,000 stores were permanently shuttered between 2017 and 2018, and around 129,000 Americans have lost their jobs. Here's an excerpt from The Atlantic. Overall, retail employment has fallen every month this year. Department stores, including Macy's and JCPenney, have shed nearly 100,000 jobs since October, more than the total number of coal miners or steel workers currently employed in the U.S. Even America's richest areas are getting hit. Employment in New York City clothing stores has fallen 3 years in a row, the longest period of decline on record going back to the early 1990s. But now, as a result of this trend, hundreds of malls around the U.S. are closing down, with over 50% of those remaining expected to close by 2022. Meanwhile, a growing number of toy, electronic, and clothing manufacturers are losing nearly all of their largest wholesale contracts. Nevertheless, this retail crisis is only the beginning of a much greater systemic breakdown. Because as more and more retail employees are laid off, fewer and fewer consumers remain to sustain the broader economy. This recent Bloomberg article says it best. There are billions in borrowings on the balance sheets of troubled retailers, and sustaining that load is only going to become harder even for healthy chains. The debt coming due, along with America's overstored suburbs and the continued gains of online shopping, has all the makings of a disaster. The spillover will likely flow far and wide across the U.S. economy. There will be displaced low-income workers, shrinking local tax bases, and investor losses on stocks, bonds, and real estate. If today is considered a retail apocalypse, then what's coming next could be truly scary. The same Bloomberg article also cites the fact that rising U.S. interest rates are the primary culprit in the current retail crisis. Notice what it says. Retailers have pushed off a reckoning because interest rates have been historically low from all the money the Federal Reserve has pumped into the economy since the financial crisis. That's made investing in riskier debt and the higher return it brings more attractive. But with the Fed now raising rates, that demand will soon soften, which may leave many chains struggling to refinance, especially with the bearishness on retail only increasing. But retail isn't the only victim of risky debt. New statistics show that a high percentage of U.S. companies are descending into zombie status, which means that these companies would have defaulted in a normal economic cycle but continue to function due to an ultra-low interest rate environment. However, all of that's about to change because newly rising interest rates are set to trigger a tsunami wave of defaults among these large zombie firms. Now let's shift our attention to what happened to the U.S. stock market in 2018. In the following charts, you will notice a steep and sudden decline in all of the major stock indexes, starting in October and continuing over the next 2 months before becoming especially disastrous by the end of December. So as you could see, the Nasdaq, Dow Jones, and the S&P 500 all took a major nosedive since the middle of October. Notice also that when we look at crude oil, an important indicator of economic health, we can see the same trend materializing. It starts to plummet in the middle of October and only worsens progressively over the next 2 months. And the same can be seen with the big tech stocks also known as FANG, which stands for Facebook, Apple and Amazon, Netflix and Google. By far, these were the best performing companies on the stock exchange for quite a number of years and had the biggest market cap in comparison to all the rest. But as you can see, they've also been plummeting since October. Now notice these headlines which picked up on this critical situation when it was happening. Can tech stocks rebound after worst October since 2008? Darlings thrown out as FANG stocks suffer biggest drop on record. In fact, it would appear that the entire stock market suffered from the severe downturn of October, as evident in the following article. Notice, Wall Street finally bid good riddance to what one professional stock investor dubbed Red October. In a tumultuous month marked by big price swings, rising fear levels, and emerging risks, the U.S. stock market suffered its biggest October decline since the 2008 financial crisis, prompting shaken investors to reassess the staying power of a bull run that began more than 9 years ago. Now, according to Bloomberg, the amount of market value lost in October was the second biggest on record, topping over $4 trillion. Notice, U.S. stock market exodus is second biggest ever. B of A says the turmoil in stocks, which has erased as much as $4 trillion in U.S. equities since the end of September, continued this month as traders feared that a global economic slowdown will curb earnings growth and end the equity bull run. Unfortunately, that was only the start of major losses for the stock market, because the situation continued to go from bad to worse throughout the month of December, as stock market losses kept mounting, breaking all-time records by the end of each and every weekly trading session. In fact, the stock market's worst October since 2008 soon became the worst market quarter since 2011. Then as we moved into mid-December, it became the worst December since 1980, before it finally became the worst December drop on Christmas Eve ever, and the worst December for the stock market since the Great Depression of 1929. But then all chaos broke loose when we had our 2008 moment. Secretary of the Treasury, Steve Mnuchin, dialed the CEOs of the 6 leading banks in the country the Sunday before Christmas Eve just to confirm they had enough liquidity. The fact that a top-level government official would endeavor to call the CEOs of these banks on the Sunday before Christmas was enough to send shock tremors throughout the global financial markets, because it looked eerily similar to the actions of the former Secretary of the Treasury, Hank Paulson, who reportedly spoke to the banks during 2008's financial crisis. Notice this headline, Mnuchin calls in the plunge protection team and summons the ghost of 2008. And here's an interesting clip from Fox News covering the Secretary of the Treasury's actions.
Connell, your boss doesn't call you on Sunday just because everything's okay. You know, the fact
so that's
that
what people are freaked
Mnuchin,
out about. That's what people are freaked out about.
Yeah, without question. You know, for me, it brings me back basically to the midst of the crisis in 2008. You didn't see really terribly erratic markets until government started getting involved. And you might remember the no short sale list for a while. Government had a list of stocks that you were not permitted to sell short.
Right.
So the more we see government, Steve Mnuchin, the plunge protection team getting involved to kind of, fix markets, I think the more you'll see people unwilling to step in and buy, especially now when prices are
we've
lower.
all been trying to figure out what was going on with that call. I mean, we've been told, Treasury's told us over and over, that was just quote unquote preemptive. There was a lot of volatility last week. He wanted to get out ahead and trying to be, I don't know, maybe I'm just speculating, maybe they were worried if he did make this call that it would get leaked, so they wanted to get it out. But it is puzzling of why you would go public with a call like that, right?
And the banks really, I mean, this started basically in October, the sell-off, and we were talking quite extensively, Connell, you remember, about the FANG stocks.
Yes.
Oh, is it going to be the FANG? And it has spread. It's spread from technology to healthcare, energy in particular, and the banks have just been decimated, one of the weakest areas this year.
But do they have problems, like real structural problems, like Mnuchin was apparently calling about, and they tell him, no, we got plenty of money to lend, we have the liquidity's okay. Was that something you were worried about before this call?
Well, I have seen it manifest in price action, Connell. I mean, take a look at, for example, JNK. This is the ETF, the exchange traded fund, that just basically gets a sense of what are junk bonds doing. They've been thrown out. Leveraged loans have been thrown out. So I do fear, and I guess I'm not a Cassandra here, and the market certainly could bounce, but I fear that the news of what's behind this massive sell-off, particularly in banks, and perhaps Mr. Mnuchin's call as well, hasn't yet hit the tape. I don't know if it's a crisis. I don't know if it's a liquidity shock, but something is very wrong when it comes to the banking sector in this country.
Interesting. Well, we're all thinking about it now, for better or worse, after the weekend. Have a good one, Jonathan. Thank you, sir, for coming on. Appreciate all the
Merry
time.
Christmas. Thank
as
you.
always.
But what exactly is triggering all of this chaos, and are we truly witnessing an economic collapse? To answer this important question, let's take a look at some of the trouble signs now manifesting, which have many financial analysts and top economists convinced that a partial economic collapse has already begun and that a full collapse will soon materialize. Number 1. 2018 was the worst year in American history for economic assets, with 90% of the 70 asset classes posting negative returns. The last time something this significant had occurred was way back in 1920 when 84% of all assets were negative. It is also significant that when compared with 2017, when nearly all asset classes were positive, 2018, only a year later, has produced such a dramatic shift in assets, dropping them all into the negative. Number 2. Car sales are dropping significantly, signaling the start of a recession. Number 3. The housing market is now entering a new downturn, and many cities are experiencing their worst year since the housing market crisis of 2008. Number 4. The retail industry is in severe crisis, posting its worst December losses in history. Number 5. The bond market's yield curve has just recently inverted for the first time in more than a decade, signaling an imminent recession. Number 6. Bank stocks are currently at historic lows and in some cases over 50% down from their yearly highs. Number 7. Stock prices have fallen more than 20% from their 52-week high and are now entering a bear market. Number 8. Multiple death crosses have manifested in the stock market as of the last few weeks, indicating a failing market. Number 9. The infamous head and shoulders pattern has just manifested in the stock market, which has historically signaled a looming recession. And number 10. U.S. stocks post their worst year in a decade. Now, do you really believe that all of these issues crept up on us completely by mistake? Or was it already in the planning for many years? To me, it is clear that a pre-existing agenda is at play, which aims to destroy the current economic system so that a new one can emerge to replace it. Just take a look at the front cover of The Economist magazine from 1988. As you could see, an Egyptian phoenix is rising out of a big pile of burning cash while holding what appears to be a digital coin in its talon. But what's really interesting is that the digital coin held by the phoenix is inscribed with a big 10 in the center, and then below that you have the year 2018 clearly visible. Next to the phoenix are the words, "Get ready for a world currency." So what's the message on this cover? Are they telling us that October, the 10th month of 2018, will mark the beginning of the end for sovereign currencies, and that during this time digital money will progressively replace the use of cash? After all, consider the fact that October did produce the worst stock market performance in a decade, and while the market was hemorrhaging trillions of dollars worth of value, the IMF was urging central banks to begin issuing digital money in the form of cryptocurrencies as a security measure. Indeed, the IMF has been very vocal about their desire to transition away from paper currency and into digital money. Just take a look at the cover of their June 2018 Finance and Development magazine, which prominently features the evolutionary process from cash to credit card, and then to smartphones and cryptocurrency. But their desire for cryptocurrencies shouldn't be taken lightly, because as the governing body and guardian of the world's monetary system, the IMF has the right to fully control global currency development, and the US has no choice but to follow their policies. But now, how does this relate to the IMF's SDRs covered earlier in this video? Good question. The IMF has made it clear that their special drawing rights currency will eventually go digital when it becomes the only global currency in use. Here's an interesting excerpt from the Wall Street Journal covering this very issue. Forget Bitcoin. Have you heard of IMF coin? The IMF would like its special drawing rights to have a digital future and has spent the past year thinking of a broader role for it. The head of the International Monetary Fund has been musing about the future of money and thinks there is a decent chance it will come from the guardian of the world's monetary system. And of course, by that they mean themselves, the IMF. But make no mistake, all of these governing bodies are ultimately controlled by the Vatican and answer to its authority on issues of finance and politics. I cover this fact extensively in my other videos where I offer innumerable proofs that the Pope of Rome is both the Antichrist and supreme head of the world's governments. So it really shouldn't surprise us that the Rothschilds, who own The Economist magazine and operate the world's biggest banking dynasty, would have insider information about the global economy since they've been faithfully serving the Vatican for several centuries. In fact, according to the Jewish Encyclopedia, the Rothschilds are officially known as the keepers of the papal treasure. But why is all of this important? Well, remember, if the Pope is the Antichrist of Bible prophecy, as I've been asserting in many of my videos, then it makes sense for the Vatican to play a prominent role in setting up the market of the beast system. And indeed, that's exactly what they've been doing as of late. For instance, consider the fact that the Vatican just recently hosted an historic meeting attended by the world's wealthiest and most famous, and that at this meeting, Pope Francis called upon the world's top financial executives to help transition the global population into fintech. Of course, fintech's primary resource is blockchain and cryptocurrencies. But what's even more astonishing is that for the first time ever, a deadline has been set by which the globe's remaining population must become fintech compliant, and that deadline happens to be 2020, a full year from now. Large financial institutions have only until 2020 to implement fintech on a global scale. Apparently, many of the world's richest and most powerful men are openly submitting themselves to Pope Francis, the current head of the Roman Catholic Church, by helping him erect the mark of the beast financial system. Now notice these excerpts taken straight out of the Fortune and Time Global Forum working plans so you could see for yourself how these companies are deeply committed to the Vatican's agenda. The following is a letter from the editors of Fortune and Time to Pope Francis delivered on December 3, 2016, and here's what it says. Your Holiness, on behalf of Fortune and Time and the distinguished delegates participating in our global forum, we are pleased to present to you the enclosed report. The report presented here is a result of the work of some of the world's most prominent business and thought leaders who have gathered for this meeting. Our goal is not only to talk about these problems, but also to take specific actions to address them. And so at this forum, top executives from some of the world's largest companies, as well as prominent non-governmental labor and civic leaders, have sought to answer the Holy Father's call to action, forging a new social compact for the 21st century. Companies will support initiatives to produce digital identities for the 1/5 of global citizens who lack one and therefore are shut out of financial systems. Digital financial technology, fintech, and the spread of mobile phones have been transformative in expanding financial access to hard-to-reach populations. Still, there remain obstacles to achieving the World Bank's goal of universal financial access, UFA, by 2020. Now, at this point, there are several extremely important questions which we should be asking. Number 1. How far along are we in meeting the World Bank's goal of universal financial access by 2020, also known as ID 2020? Number 2, why does the IMF want a digital global currency? Number 3, what is the relationship between digital money and the mark of the beast? And number 4, how does a global economic collapse benefit the Vatican-run IMF? To answer question number 1, India became the first nation to implement biometric digital IDs and now has more than 1 billion of its 1.25 billion residents digitally ID'd. Consider also that by the end of 2019, 60 million refugees are expected to be digitally ID'd as well. So it would seem that the only countries that are behind in this program are Western nations like the United States. But even the US is pretty close to meeting the ID 2020 expectations, because there are currently 28 states that are now Real ID compliant, and all remaining states have until October of 2020 to switch over to Real IDs. But it's important to realize that these biometric IDs are the start of a global cashless society. For instance, consider the fact that when India started to provide digital IDs for their residents, they did this while attempting to become a cashless society. Notice this excerpt from the Washington Post. It's been nearly 3 years since Prime Minister Modi announced his Digital India initiative, pitched as an ambitious program to modernize this country of more than 1 billion people. Since then, the government has abruptly invalidated 86% of the cash in circulation, a move toward a cashless society that led to widespread panic and a currency crisis. So as we could see, the ultimate goal of this whole biometric ID program is to move the global population into a cashless society. Now here's another important excerpt which describes this endeavor in even greater detail. As technology is making the world more connected, traditional barriers and borders have begun to dissolve. We are beginning to see more people choose to become global citizens. Blockchain technology in particular has many potential applications pertaining to global citizenship. Here we will look at the early foundations already being established for a globally recognized digital identity system or systems. As of July 2018, we have seen a mix of both government-led blockchain initiatives and privately run blockchain projects. When it comes to blockchain adoption on a national level, Estonia is clearly one of the most innovative examples of today. In 2017, the Estonian government announced plans to create its own national cryptocurrency called Estcoin. Policymakers also began to create a blockchain-based digital identity system. Okay, so now where do you think this blockchain digital ID program is leading everyone? Could it be that this is the start of the UN's borderless world of global citizens? Well, here is proof that that is exactly what it is. BitNation, for example, is a project aiming to serve as Governance 2.0. Back in 2015, Janina Lois gained a lot of attention for becoming the first holder of a blockchain ID. Since that time, the project has grown in scope. It has tens of thousands of users and has become the world's first blockchain for marriage certificates, birth certificates, refugee emergency IDs, world citizenship, DBVN constitution, and more. Now, by the way, just so you realize, BitNation is the world's first decentralized borderless voluntary nation. But to answer our second question, which relates to why the IMF wants a global digital currency such as their SDR, the answer is pretty simple. Digital transactions are easily traceable and give the government complete knowledge of everyone's whereabouts at all times and the type of payments they are making. There is zero privacy from government scrutiny once digital money is implemented on a global scale. Just take a look at this brief news clip from Fox on this very issue.
If you criticize the government, even a family or friends, I mean, this is...
It's going to track what apps you're on your phone. It is Big Brother writ large, and if you think about the steps that Venezuela, Russia, and China are taking to implement their own cryptocurrencies, by 2020, I suspect they will be able to track their citizens' every economic move. I mean, the disparagement of economic freedom, of personal liberty. I mean, just when you think that China is so strong and clamps down so much, if there's an economic slowdown coming, they're going to have to maintain social order.
So you see, eventually, when Christians begin to resist a cashless society or market-to-beast system, they will be forced to forfeit the right to buy or sell because digital money cannot be used outside of an electronic blockchain system. Now, as far as our third question about the relationship between the market-to-beast and digital money, let me spell that out for you also. You can be certain that the ultimate aim of world government is to completely control people's actions and thoughts. Rome's Jesuits would like to impose all of their religious and ideological beliefs upon the entire globe. At heart, the Jesuits are simply Luciferians and anticipate a global era of Luciferian worship. Christians recognize this as the Great Tribulation period. But for several decades, Rome's Jesuits have been using advancements in technology to create the perfect device by which to completely control mankind, and that device is known as the RFID chip, or more commonly, the microchip. Once implanted, the microchip enables the government to track your every move. So in effect, electronic money must have an electronic wallet to go along with it, and that wallet is the microchip. The microchip will be your personal wallet, bank account, and personal ID combined. But since the microchip is integrated with GPS satellites, it will also function as a trackable device which will keep tabs on your whereabouts 24/7. Now, in case you were wondering about the specific relationship between the microchip and the actual mark of the beast mentioned in Revelation 13, I hope to publish another video covering this subject separately sometime soon. And finally, let's look at our fourth and last question concerning the way in which a global economic collapse would benefit the Vatican-run IMF. You see, in order for the governments to successfully implement a new financial system, they must first ensure that the old one expires quickly, even if it's intentional. So the only way to transition a large population of nationalistic or patriotic Americans onto a global monetary platform is by injecting a large amount of instability and discomfort into the economy. Once citizens begin to grow panicked and concerned about their daily survival, they will be much more willing to relinquish their national sovereignty in order to regain a comfortable and stable economy. So make no mistake, we are now at the point where we are witnessing the beginning stages of an economic meltdown which will be used to accomplish the aims of the Vatican agenda for world government. So what exactly can we expect in the coming months? Sadly, there are many Christians in America who have placed their faith in the current administration of President Donald Trump. As a result, they expect Trump to maintain and protect their best interests. But this blind trust in a high-ranking government official is very dangerous, as history has repeatedly shown us. If anything, we must not expect President Trump to rescue America from certain calamity. What we must realize is that Trump is a Pied Piper for the Vatican and their New World Order agenda, and he's following their playbook with perfect precision. Because you see, while the Federal Reserve's role was to deliberately inflate the gigantic debt bubble over the past decade, Trump's role is to bring about the implosion of that bubble, just as we've been witnessing so far during the final quarter of 2018 and the start of 2019. So make no mistake, the underlying agenda is a controlled demolition of the U.S. economy and the dollar to open the door for the global reset. The reset is the event that the Vatican hopes will allow them to introduce a single global currency and a single world economy with the IMF at the helm. But since the elites need a patsy for the breakdown of the financial system being engineered, they've chosen Donald Trump. Trump is the scapegoat for the crash of the debt bubble, and you could be sure he'll wear all of the blame while the Vatican continues to carry out their agenda without suspicion. Now also, we could expect world governments to gradually replace cash with sovereign cryptocurrencies in order to acclimate their citizens to the ultimate cryptocurrency, the IMF's SDR. Consider the fact that in December of 2017, Forbes magazine predicted that the US government would soon step into the cryptocurrency arena. In the same article, Forbes also revealed that currently 108 countries are experimenting with switching over to a digital currency and leaving the US dollar reserve, and that over 20 of these will begin beta testing toward this goal soon. And back in July of 2018, the US government held a public hearing on the future of money and digital currency, recognizing the versatility of blockchain technology upon which digital currency is founded. unfounded. But here's something very important. Digital currency works flawlessly with RFID microchips. And BuyChip, the maker of the RFID microchip, has just released an update to their microchips, which will enable their customers to own a virtual wallet with digital currency such as Bitcoin. Now, the following excerpt from CNBC will give you the clearest glimpse of just how close we are to the one world digital currency system. Next stop in the cryptocurrency craze, a government-backed coin. In light of the rising popularity of cryptocurrencies like Bitcoin and Ethereum, central banks around the world are busy experimenting with their own versions of digital currency. China's central bank announced in January that it has completed a successful trial run of transacting digital currencies among banks. Then in September, Japan, Sweden, and Estonia all announced similar digital currency projects. J-Coin for Japan, E-Krona for Sweden, and S-Coin for Estonia. The UK, Uruguay, and Kazakhstan have all expressed similar ambitions. On Wednesday, William Dudley, president and CEO of the Federal Reserve Bank of New York, said the Fed is exploring the idea of offering its own digital currency. Now, we can also expect and must prepare for a catastrophic implosion of the U.S. economy. The global financial meltdown that began in October of 2018 will no doubt continue to worsen over the next year, though we might not enter a complete economic freefall or death spiral until sometime in 2020. But make no mistake, the global economy will progressively worsen as we continue forward, especially as the stranglehold of rising U.S. interest rates is felt by the markets. For instance, we might begin to see local governments and even individual states filing for bankruptcy, etc. Also, it is likely that the stock market will appear to rally several times between extreme losses, and there may even be occasions when an economic recovery looks certain, but these temporary upswings are false market moves meant to mislead the public. So we must be careful not to drop our guard or become too confident in the current financial system. Now, having outlined all of these facts, I realize that the forecast for the future looks pretty bleak and gloomy, and the question naturally arises, what should Christians do to prepare? How can God's people become sufficiently ready for these extremely troubling changes that are even now at our doorstep? Obviously, there are many pertinent factors to address in regards to preparation. For instance, there is physical preparedness, but even more importantly, there is also something called spiritual preparedness. It is imperative to realize that without spiritual preparedness, all of our physical preparations will be useless. In other words, only God can rescue us from the flood of evil that is coming. So what does spiritual preparedness look like? First and foremost, it involves lots of prayer, but not just any kind of prayer. Not the ritualistic, superficial, 5-minute mumbled prayer. God wants His people to begin to cry out to Him earnestly from their hearts with passion and desire. So prayer is essential to spiritual preparedness, but so is living a holy and obedient lifestyle. Hebrews 12:14 tells us that without holiness no man will see the Lord. So spiritual preparedness involves prayer, by which we maintain our relationship with God, and it also involves obeying everything written in the Bible. If you begin there, God will lead and guide you as to what you should do and how you can prepare for the coming global chaos. Now, many of you might not believe in the continuation of the spiritual gifts post the New Testament Canaan. If so, you are discounting an important role of the Holy Spirit in the performance of such things as prophecy and visions and dreams. And as a result, you may be spiritually handicapped without realizing it. Because by relying strictly upon physical and practical means of recourse, you are greatly limiting God. But you see, God would like to speak to you supernaturally through a prophetic word or a dream in order to give you step-by-step specific guidance for these last days. He would like to direct you concerning where to go and the means you should use to prepare for the future. So I urge you to read my article on the gifts of the Holy Spirit to learn more about this vital issue and whether the supernatural work of the Holy Spirit continues till today. Now, there are also some practical things that Christians can do and should do in order to prepare. For instance, your physical preparations should involve learning how to survive in the wilderness without the use of modern tools, and how to practice subsistence living strictly from the natural resources available in the wild. In respect to this invaluable skill, I recommend taking the time to watch the YouTube channel Primitive Technology. It is incredible what people can build and how they can survive strictly through natural means without the use of modern tools or weapons. One thing I should definitely mention at this point is that I highly discourage investing one's money into precious metals. Contrary to what many will say, you absolutely don't want to waste your time accumulating gold and silver. All of my research into the history and use of gold as money has convinced me that such investments will ultimately fail. Historically, the U.S. government has passed several anti-gold hoarding acts, such as Executive Order 6102, to prevent its people from relying on gold as a means of transaction, and several people were even imprisoned for not relinquishing all of their gold during the Depression years. And finally, I would like to discuss with you why I made this video and what motivated me to pursue many hours worth of research into economics, the stock market, and the new wave of blockchain technologies currently being implemented. It all came about as the result of a significant dream which I received back in February of 2018. In this dream, I saw the complete demise of America. The details of the dream are irrelevant, but after waking up from this dream, I was strongly impressed with the realization that A, many people will be caught totally by surprise when disaster strikes the heart of this great nation, and B, the destruction will be swift, complete, and irreversible. Now, in conclusion, my prayer is that all of us may turn to God for the strength and grace needed to face the future. May we find our security in the redemptive work of Jesus Christ and in nothing else. That's all till next time.